you just mentioned tariff will impact the economy, especially the inflation and the unemployment rate, and that essentially will follow with potential recession. How do you think about the possibility of a recession coming soon?
I was expecting that the economy would slow down this year, regardless. Maybe not enter a recession,
Okay.
but definitely grow at a slower pace. The tariff situation changes the math significantly. It seems more likely than not. If we do implement high tariffs, and if our trading partners reciprocate with higher tariffs, we probably will see unemployment go up. We probably will see inflation go up. Under those circumstances, it would not at all be unusual to see a recession hit. What a lot of people forget is that about 70% of our economy is consumer spending. And if you have a recession, if you have higher unemployment, people do tend to spend less. By itself could drop us down close to recessionary levels. So I would not at all be surprised. I do think if we have a recession, and this is based on what we've seen during other periods where tariffs have come into play, the recessions tend to be fairly short and not terribly drastic. And usually when we enter a recession, it's renters who get hit first before homeowners. If it's a short, mild recession, it may not have a huge impact on the housing market, but we will see delinquencies go up on mortgages. We will probably see a slight increase on foreclosures, but the foreclosure market has been running at historically low levels now for the last few years.
Yes.
So we're kind of overdue to see those numbers tick up a little bit.
Okay. All right. Other thing on top of that is about the interest rate. To me, it's a dilemma that if we say due to the tariff or other stuff, the inflation, then the Fed need to cut the rate. But if we see the economy goes down, even towards the recession, then we have to cut the rate.
Yeah, it's not a fun time to be Jerome Powell right now. And I do respect the fact that what he's saying is we're going to wait and see what happens and then react appropriately. The Federal Reserve has a very difficult dual mandate. They're trying to maintain full employment, trying to keep inflation under control. And it's always hard to balance those two out. But when you have a situation like this where you're likely to see rising inflation and rising unemployment, the consensus thinking is that if the Fed had to pick, they would pick cutting rates in order to bring employment numbers back up.
Sure.
But I don't think they would be as aggressive with their cuts as we would have expected. If we see the tariffs implemented, if we see inflation start to go up, we see unemployment start to go up, I do expect we'll see the Fed cut a little bit, but probably not as dramatically as they would have done under normal circumstances.
Oh, okay. The reason I bring this because I know that commercial real estate, especially my field on the multifamily side, the major topic, a lot of owners waiting for the interest rate to go down so they could do the refinancing. Now we see a lot of deal pump up way more than last year because of, I would say, the grace period from the lender is already end. A year later, the interest rate is still high. And I think more owners have the same situation now. Their loan is maturing, and then they also have to consider whether they could wait a little bit until the interest rate is down or not. And the interest rate also impact us for small investors to consider the single-family townhouse purchase or sale. Do you think it's a good time to buy or a good time to sell?
Yes, it is.
It's both.
It's always a good time to buy or to sell, depending on your circumstances and your market. There are various sectors in the commercial segment, industrial and retail and office and multifamily, the apartment area that you're talking about. A lot of it has to do with population trends. Are you in a market where people are moving in and population is growing? Are you in a market where there's more jobs coming up, where wages are going up? If you're in a market like that, probably a good time to be investing in properties. If you're in a market where people are leaving or where jobs are being eliminated, a much tougher market to be involved in. And You also have to be kind of a psychic and figure out what's going on, beyond you in the market. Is the industrial segment, for example, going to suffer a little bit if the tariffs are implemented because there's going to be less export business or less import business, so you have less need for warehouse and distribution centers. So there have been so many different things going on in the market. We've had 1 million apartment units come online in the last 12 to 18 months, almost a record number. There are some markets where you'd have to be very careful about buying a new apartment building or apartment complex because it might be overbuilt. And we've seen apartment rents come down as a result of that. There are other parts of the country where we still have people moving to, and there's not enough housing. Might be a good opportunity for single family rentals and for multifamily. So I think that finance rate is only one aspect of what's going on. We've actually seen cap rates across all those sectors improving slightly over the last year. And you have to remember that finance rates aren't directly tied into the Fed funds rate. They're more closely aligned with what we're seeing in the bond market. After a little bit of volatility, the bond markets seem to be settling down a bit, which is one of the reasons I believe mortgage rates will come down. As mortgage rates come down, you'll see those other business purpose loans, the kind of loans you get on commercial properties or on single family rental properties, those rates should come down a little bit as well. I can't tell you whether it's good or bad to buy or sell in your personal situation. Really depends on the type of property, what's going on in your market, what financial circumstances you're looking at as an individual investor.
That's fair enough. Since right now we all talk about the uncertainty of the economy and the market, what are the major index important for real estate investors?
I do look at unemployment numbers and job growth numbers. I look at wage growth as well. The average hourly rate of pay for workers across the country right now is over $30 an hour. So wage growth continues to go up a little faster than inflation and a little faster than home values are going up. I do look at GDP numbers because they indicate overall economic strength. And that certainly has a bearing on people's ability to buy a home or to rent a property. So you need to look at those. And then I do pay attention to the rate of inflation. So there's subcategories under that. If inflation goes here, what's the Federal Reserve going to do with its rates? I do like to look at local and regional trends where I can, because that old saying about real estate being local is an old saying because there's a lot of truth to it. What's going on nationally, very, very different. In Hartford, Connecticut, property values are going up significantly because there's so little to buy. In Houston, Texas, the opposite is true. Really need to understand what's going on in the market where you're doing your investing. And that's more important than what the national numbers suggest. One more thing that a lot of investors may not be paying attention to, but need to. This is true whether you're a fix and flip investor or you're buying a rental property to hold on to. Pay very close attention to what's happening with property taxes and insurance rates. Homeowners insurance has gone up 27% nationally over the last 3 years. If you're in a market like Florida or Texas or Colorado or even parts of California, it's not unusual to see your premiums double or even triple year over year. There are also parts of Florida and California where you can't find anybody to give you insurance. If you're buying a property with the idea of flipping it, you need to factor in that your sale price may not be as high as you'd like because the new buyer is going to have to factor in much higher insurance costs. If you're going to be buying a property to rent out, you need to factor in increased property taxes, increased insurance premiums when you're doing your math to figure out, how much you're going to need to charge with rent in order to have a positive cash flow. So all of these things factor in much more seriously today than they've done in years past, where insurance and taxes were just kind of an ancillary consideration. But today, they're becoming more and more a part of your monthly costs.
Great. Once again, thank you so much, Rick, for your insight and for all this advice to all our audience.
Well, thank you for having me. And next time we'll do this in person.
Yeah, next time would be the Labor Day again, just like last year. We'll see you there in person.
All right, take care.
All right, bye.